Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy Live Trading Room. Live streaming from TikToker. Gold is trading last at 1734.70, up 220. And let's take a look at the different levels here that we have. For today, the average price is 1735. The sell one level is 1754, and the sell two level is 1773. The extreme below that mean is 1716 to 1698. One of the things that we're dealing with right now today is some economic indicators that came out regarding some bank regulations that they're not going to change the capital requirements, I believe, of some banking regulation that gave them certain flexibility during the pandemic. And that's kind of putting pressure in the market short term, as well as interest rates have risen or are going up, you might say. They're at 174.60 right now. And so we seem to be inching our way up here on the 10-year note. What appears to be an uptrend pattern developing here. So we want to watch this carefully, see what short-term interest rates or the rates for the 10-year note are indicating, because it's becoming very crucial in order to maintain the current status, you might say, of the debt structure with regards to payments. Any kind of financing that was anticipating, these rates to be under 1%, or, we're looking at almost doubling interest rates. So, in a short period of time, too. And this is what's catching everybody by surprise right now. And it has a lot of companies nervous. It's got the market nervous. And so the question that I think the market continues to ask is, are interest rates going up? Are they going to go up? Is this the beginning of a rise in interest rates? And I think if you take a look at the fundamental picture with regards to the debt structure, with regards to the amount of stimulus that seems to be required to get us out of this financial mess that, excuse me, the pandemic was responsible for. I think it's putting a question in terms of the long-term implications of all of this. And we have yet to see any kind of financial recovery or economic recovery that would justify, you might say, for interest rates to permanently begin to go up. I think this is an anomaly that is being resolved right now with regards to whether interest rates are going up, because it appears that if it does, and if they do begin to go up here, it's going to put tremendous pressure on the cost of maintaining that debt. And the tail end of this debt is exploding, particularly now with the pandemic. The damage that was caused economically is making that tail end of the debt look almost like a hockey stick. And if we get interest rates to go up, we're going to have to deal with paying the cost of that explosive debt. And I'm not sure that it would be advantageous for the U.S. economy or for the world in general, for the world economy in general. So I'm looking at the gold market here, and first of all, just like everybody else, wondering, what's it doing here as we continue to increase this tremendous debt that we have globally, not only here, but globally. And dealing with the pandemic that doesn't seem to be disappearing completely. We have different variants now that seem to be appearing here in the US and in Europe. They're talking about another lockdown, possibly. And so I don't think the world is out of the wood, out of this mess, completely out of this pandemic. And I'm not so sure how the system economically will be able to handle another lockdown. And so when you really think about it, I think the pressure is more, or the path of least resistance is in maintaining interest rates low. Obviously, even more now with the possibility that we may go into another lockdown. So there are, I believe, a lot of unresolved issues fundamentally, and they're very difficult to try to make sense and make money on those fundamentals. As you can see, the stock market today is reacting to this bank regulation that seems to be going into effect. And so there is a lot of uncertainty that is looking for direction. Very quiet day for the rest of the markets here as I'm taking a look at the board. And so what do we do with gold here today? Well, there's nothing to do. There's no trades. The market is trading around the average price, and the AI of the VCPMI in its probability model that it uses right here, identifying the average price, tells you basically that when you're trading around the average price, that you do nothing. That basically you simply watch the market. If you decide to trade around the average price, expect to get chopped up. It's 50-50 standard deviation. So once again, it's very choppy and it can go up and down. What we want to see is the market decisively making a directional move either to the extreme level above 1754. We're looking at the weekly at 1751. And that's pretty close to the sell one level. And this is what we're pointing out here today, that the sell one level seemed to be aligned with a weekly level, 754 to 751. That's pretty close. And the area above these levels are what it's called distribution of supply area. And the sell to level is 1773 of the daily, and the weekly is 1777. Very interesting. So now we're identifying a harmonic alignment almost the sell 1 daily and the sell 2 weekly on both the daily and the weekly, and into an area of distribution of supply. And what I want to point out to you is that this area, when it identifies that this is a high probability area of distribution of supply, it is like a magnet to the price. It's the extreme above the mean. And yes, these are pivot points that we use, but the VCPMI interprets the probability, the mathematical probability behind that, and it tells you that you don't want to buy up here above 1754. You want to wait because you're entering a very high probability area mathematically where you can expect sellers to come into the market. And so, and it could go all the way up to 1777. So this is a very crucial area between 1754 and 1773 that we need to test the supply up there. Again, what this is about is, for me, identifying, if I'm day trading, where is the extreme levels above and below the average price for that day. And so now that I have the average price, which is 1735, I have no position on the futures contract. We're talking futures contract. And this is what I'm coaching and teaching here, using the futures contract on a daily basis in terms of how to trade the structure of the VCPMI, using pivot points, Fibonacci sequences, vortex mathematics, directional movement that encompasses a very simple structure that converts the structure into a probability model. And that's what we're looking at. The algorithm was written in C++ in easy language, and it is an automated algorithm. And what I'm doing here, once again, for the benefit of those traders that are serious, that do want to make a difference in your trading. If you've been trading for a long time and you haven't found what works for you, you haven't connected to anything, I would suggest to take a look at this incredible tool, which is a completely mathematical tool. There's no emotion behind this tool. As you can see, we have a daily pattern that is telling us there's no trades today to do unless the market explodes into this 1754, 1777 area, or it tests the low below, which is the 1716. And as you can see right below that, it's the 1712 range, the weekly range. Now, the thing that is important to note in terms of some of the what I call determining factors in succeeding with the VCPMI is to identify the harmonic alignment. And, we don't know when that is going to happen, except that when the price relationship is very close, like here, for example, even on the extreme below of 1716 to 1712, this is a harmonic area. And what the algorithm identifies this area is that this is a very strong mathematical probability area that more than likely the market will revert from here. The reversion to the mean principle basically is the core, the essence of it is that the price will revert from the extreme above the mean to the extreme below the mean. The price always will revert back to find its equilibrium, to find its average. And sometimes because of the supply and demand, more sellers, more supply, obviously, will take the market down to the extreme below the mean. And in this case, this area of 1716 is a critical area in terms of buying the market on the long side. It is matching almost harmonically with the weekly. And for short-term trading purposes, that's what you want to look for, is the alignment harmonically, ideally on all of the trends. And we're talking price, which is a consequence of the energy behind. So by the time the price completes the pattern anticipated by the algorithm, this pattern is completed. And it tells you, go neutral when you meet that target. Go neutral. Take your emotion out of the trade. And then wait and let the market confirm it. And a close above now on the next bar, using the 15-minute bar, will tell you what the market wants to do. And here it told you that there are buyers coming in. This told you in blue, expect that this is what's going to happen. It happens, it confirms it, validates it, and the market enters into a trend directional signal, giving you a buy at 1722.70 with a stop at 1716, automatically below. And 3 stops, 3 choices. Don't use a straight stop until you start to gain equity. And the minute that you begin to gain a profit, then you trail it with a stop to break even initially, so that the worst case is that if it comes down and takes you out, you're breaking even. You get another chance. Now, when the signal is activated here, the target automatically is boom, above, met, completed, and you go neutral. And this is, when it tells you when you meet the target, when the reversion occurs back to the average from above or below, you go neutral. You take a neutral position and you allow the average price to resolve the supply and demand. As you can see, once it completed the pattern, it's trading choppy around the average, which is why I'm making an effort here to point out the energy of the market in relation to the average price, how it adheres to that average price until you get more buyers or sellers from here. And either it's going to come down to the extreme below or, go up to the extreme above. The silver market $26.17 up. I'm sorry, down about 17 cents. is a little bit stronger than the gold market here, in that we've been trading pretty much also around the average, back and forth as well. And so once the target is completed, the AI tells you just relax, rest. For day traders in futures, this is the intelligence for now. Now, if we take a look at the market, what it's done, or what it's doing in a little bigger picture here, what we're looking at again is that the market is making what appears to be a bottom completion from the 30-35 high that we made recently. And I want to bring this down and see a little more accurate. Now, from the lows made, where the support levels are for using Fibonacci retracements. And you can see here, let me change the chart here for a minute so I can am able to show you a little better. Here, you can see here the action of the market for this whole week basically has been trading at this level here of 25.77. And this level coincides again with the numbers pointed out to you that is in perfect alignment daily, weekly. Now, overlapping the Fibonacci retracements, it validates that the market came right down into almost exactly that line of support. These are Fibonacci trend lines that are used to identify price fractals in how do they fit into the code, the VCPMI. And this is the validation for me that we're getting a lot of alignment into this levels harmonically, not only in price, but also in indicators. And that's a pretty good setup because we're getting the technicals that we need to see, basically that we want to see in identifying the major bottom in the silver market here. So you can see the pattern is building a pretty bullish pattern, but we are trading on the average, and so let the market, pretty much do what it's going to do. If we close about 26.26, it's going to activate the bullish trend momentum all the way up to 26.63 to 26.71. Also, you can see in silver, we're getting an alignment at this level, 63 to 71. And that's going to be a primary target for us for the time being, short term. And then we want to see what the market does up there. Below the market, you're looking at a tremendous harmonic relationship of 25.84 to 77. So what it established here is a perfect trading range for you to trade. For you, self-directed trader, obviously, to identify a trading range, a trade, and for all intents and purposes, a structure, a mathematical structure in price. The E-mini S&P reacted, as you can see on the news this morning, came down. The supply came down, brought the market down into activating a buy signal, 3881, which is the buy one level, and came down, activated a buy one level daily, and now it's activating a bullish price momentum signal with a daily buy trigger. And the price, the targets that we're looking at are 39.30. For the daily target is 39.30. And for the weekly target, you're looking at going back up to 39.93, unless the signal is negated. 38.90 close above is activating a buy signals for the mini S&P. Once again, you're getting a daily buy trigger and a weekly bullish trend momentum by the market closing above 38.90. Very quiet market here. Let's watch the market a little bit here and trade as the market seems to be looking for direction here. I think if we get the 10-year note to 2% here, it's going to create havoc in the financial markets, and I'm not so sure that the Feds are going to allow that to happen. I think we're going to begin to hear talk once again. Yield control, yield curve control is what's coming up. We're getting a buy signal here on the mini. A close about 38.90 is going to activate it by a bullish trend momentum with the buy signal underneath. That's a pretty good signal. We're going to pick up a E-mini S&P because it's basically given us a double indicator, which is the average price and the daily. And so we bought an E-mini S&P 38.90, 92 here. And automatically, when the signal is activated here, your target is identified above, which is that 39.29. And we give you three choices. of a stop. Again, you have a catastrophe stop, a maximum dollar stop. A close below the level would be a conservative stop. And the aggressive stop would be at the end of the day. You can hold on to it till the close, depending upon how you want to manage your risk. $94.25 bid, fast market, 94.50. If you once the market, again, like I said, once it begins to move in your favor, that's the only time that you want to consider a straight stop. We do not use a straight stop until you have a couple of $100, $200 or $300 gain in profit, in particularly because you got to consider the volatility of the market that you're in. And in this case, the mini is a very volatile market. So I have a catastrophe stop in place automatically. Okay, that suits my profile. And for the mini, it's $1,000 risk. I'm willing to risk as a catastrophe stop. If it goes down below that for me, I'm out. Particularly if you're doing multiples. Or if you're doing multiples, you can use that to manage the multiple positions that you have. So everything depends upon your profile, what is comfortable for you, your profile for risk and money management, in terms of how you apply the intelligence. As far as the signal is concerned, the VCPMI gives you a very clear signal where to buy, the target, your stop. It doesn't tell you how to trade it. It doesn't tell you how to manage your money, what instruments you can use it exponentially, for example. We're talking about a directional signal in the futures contract, but if you're an experienced trader, you know that you can exponentially apply the signal into other assets that are related, derivatives that are related, ETFs, stocks. So this is the E-mini S&P Standard 500 Index that gives you the directional signal. And obviously, you can trade anything underneath that index, any derivative underneath that index. The gold market is inching its way up above that average of 1737. The only thing I'm looking for today is for the trend to validate that we're unfolding into a bullish trend momentum, because I do and I am carrying a core position long term. My subscribers in my trading room, my traders, I've been recommending for them to build a portfolio to buy corrections into this metal as the market comes down and tests these lows here that made, particularly that was made recently. So I am bullish. I'm very bullish metals, and gold and silver in particular, as I trade short term some of the signals here in some of these other markets like Bitcoin, and I use GBTC to trade Bitcoin. And obviously the S&P. There are plenty of activity and volatility in the markets for you to trade if you're a self-directed individual. One of the things that I have found for myself is, that for me personally, I can only trade certain markets. I can only trade a number because I want to know everything about those markets when I trade them. It's a lot of information to digest, when you're looking at, 80 markets or 90 markets there. We don't have any signal here on the metals, but the action is very friendly, and we're trading within the range, again, the daily average and the weekly average. The path of least resistance is to the upside from these levels, according to the VCPMI. $172.6 on the 10-year note. It's down 0.003. But I'm keeping a sharp eye on that note because that's what I believe is going to be the rocket fuel for metals. And I don't believe it matters, to be honest with you, what those rates are going to do. I think we're going to find the relationship completely synonymous, so to speak, in that we're going to see rates go up and the price of gold go up as well. We're moving into an inflationary environment. There is no question. It's just a question of how fast we're going to get there. Not so sure, particularly when you're taking a look at this potential spike again, and having another lockdown would be devastating, to say the least. So the pressure is to keep the lid on interest rates. Keep the lid on interest rates because the market and the world needs liquidity right now to get through this pandemic. really, that is the bottom line. So we can't have rates going up. And when the market realizes that, obviously, you're going to see gold and silver explode. The 10-year note is rocket fuel for gold and silver as money, as real money. And silver is becoming the focal point, you might say, of identifying what happened to real money. Real money is trading at $7 an ounce, which is incredible when you really think about what it represents. And so buy all you can at this price before it goes to 50. And then you're going to be saying, I should have, could have, would have. This is a major shift in our economy. This is not something that is going to, disappear overnight. We have entered a whole new economy, a virtual economy, as we are trying to come out of this physical economy, the old economy that basically collapsed. So if you're following the trades that I'm doing in real account, make sure that you have a maximum dollar stop that you're comfortable to risk, or use the indicator, which is a close below the level that activated the signal. In this case, I'm referring to the mini. That is the signal that's active today. And we're going to see. We're going to take a risk. We follow the signal, and whatever's going to happen is going to happen. When you entered into the signal, whatever the market is going to do, it's going to do. And it doesn't mean that because the signal is activated that it's going to be 100% correct. That it's a guarantee, because it's not. It's a probability model that you're running, and that could be negated as well. And so for that, you have the stop, you have the maximum stop, and you can let the market do what it's going to do. You can see the A-mini is picking up steam in here after testing a little bit a level below, and we're moving in the right direction. The target automatically is 39.30. If you took the signal and you got a profit in there, just put your stop, your initial stop, at your entry point, and just let it go. The market will do what it's going to do. So now you just fasten your seatbelts, and you have the structure defined. So this is an example of the relationship that I identify as being harmonic alignment. It's a pretty powerful relationship if you can identify it. And the algorithm does it. And it tells you, the intelligence tells you, a close above here activated a buy signal. 91.50 was the close. This is when the signal was triggered. Your initial stop could be 38.90 or 38.81, which was the seller one level. So you have the trade boxed in. You have your risk defined, your target defined mathematically. $96 bit. Yeah, gold is spiking through that 1735 average price. And once again, I'm watching the market resolve the supply and demand for today. And right now it's trading at the average price, which is fair value for today's trading. That seems to be 1735. On the weekly, it's trading above the average price of 1712 with a target of 1751. $96.25 bid. Traded $6.50 bid. So we're getting buyers come into the mini signal here. And, let the market do what it's going to do. $6.50 traded. Yeah, it's a very quiet day across the board, basically, in metals. And this is the only signal that we have here that we're trading. 97 traded. $7.25. $7.25 bid. 775 traded, 98 bid. We're getting up there. So this is an example of the reversion to the mean principle, or mean reversion trading. $850 traded. 875. Nice move. Picking up buying here, picking up buyers. Buyers are picking up the supply that was offered previously, as the AI anticipates. So now you see the algorithm unfolding, materializing its objective, and we are picking up momentum. This is what you call momentum. 03 traded. We want to see some nice big green bars unfold and take us home all the way to 39.30, which is our target for the day. Now, we're looking at a day trade in the mini, where most traders, they look to trade for 2 or 3 ticks. And what you're looking at here is the incredible energy of the VCPMI that can produce for you some very substantial returns, even if you're day trading. And you don't have to second guess, where the market is going. Now, the indication of the E-mini S&P turning around basically is actually very supportive for precious metals as well, for particularly gold mining shares, which are, obviously closely related to the stock market because they are shares. But they do follow the direction of the gold market, the directional signal, particularly of the futures market, which has been the primary indicator when you're trading in the metals. And what we're beginning to see here is that relationship is changing as the physical market in gold begins to take more precedence, begins to take more control, because we are running tight on supplies. And I want to point out to you, I shared very constant information in my live trading room here, and one of the things that I'm beginning to recognize here is that we are getting an inversion. And gold has inverted yesterday. The spot month in gold closed higher than the March or April delivery. As we end the March contract, the volume obviously is dropping, and It'll go into the April contract. The cash market still has 5,000 contracts open for delivery. As this March expires here at the end of the month, we'll move into April. And you see the market has a premium in the cash market of over $1.60, 61. This is an inversion. This means there is a tightness in the cash market. And back in March, this premium went to a positive $80 over the paper market, which is the futures market that we trade, which is called the paper markets, the futures contracts. And this is where predator selling occurs, that essentially can sell substantial amounts of paper supply that have nothing to do with the cash market, basically. $39, we're back again into the mini. So what you have seen here today is simply the way that I interpret the VCPMI, the way it was written, and I adhere to the ways that our self-directed individuals can benefit by this information. And feel free to contact Ticket Talker, any questions that you have. I have a great deal of intelligence to share with you. If you are a serious trader, come visit us. I think you'll find the information very refreshing, very effective, and it's completely mathematical, out of the box, so to speak, of the chatter. Anyway, have a great weekend. Thank you again for the opportunity to share this information with you. Take care of yourself. I'll talk to you next week.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Steve Collegian here with John Najarian, folks. We're at Master Control here at Ticker Talker. And Stephen, this is an amazing platform you've built where basically not only do people get to follow right along with you and your pro traders here, but you're